Howdy, Jacob here. Today we're looking at BGC Group in the capital markets industry, just under 4 billion market cap on about 4.3 billion enterprise value. They operate as a financial brokerage and technology company globally. Growth is very lackluster, 1.7 billion revenue in 2014 to just under 2 billion in 2023. That might be a percent a year. Gross margin in the 40% range, operating margin maybe 9, 10, 11%. They currently pay a dividend just 4 cents a share, and it's just a 1% yield. Very poor return on invested capital, low single digits. Balance sheet has 656 million with no short-term debt, 1.2 billion long-term debt. That long-term debt is less than 3 years of their 5-year average, so not a concern there. Their use of cash is mostly share repurchases. The dividend of 1% yield pays out maybe 10%. A little bit on acquisitions, but again, majority is just going towards share repurchases. And this might be a quick video. Let's get ready to make some assumptions here. Revenue growth, maybe I'll be generous, do 3 and then 12. And then for margins, let's do 10, 12, share change. They bought back a lot of shares, but oh my gosh, stock-based compensation is huge. Okay, well, that's a lot. Dang. So with 50%, let's see 75% capital allocation to that, you're still looking at like 250, which is going to offset that a little bit, but it's issuing 100 million shares, which is like 3%. So, okay. So that's why free cash flow is a lot higher from stock-based compensation. And even with them buying back $250 million worth of shares per year, it doesn't offset their stock-based compensation. In fact, we're assuming 3% increase due to the fact that stock-based compensation is about 3 times higher, 3% higher than their share repurchases. The dividend figure, they've kept that the same the last couple of years, so I guess it's a little bit higher. Maybe I'll grow that with their revenue, but it's still just looking like an expensive stock at this price. I don't think it even looks like the best company, like I really want to own it. There's so much stock-based compensation. You're really not owning more of the business because they're issuing more shares to their board and directors and such, and so they already use or whatever it may be. So just not. I think I was being somewhat generous even with these assumptions, and it still looks like it needs to fall 71% to get the return I'm looking for here. So I'm just going to wait. I'm going to be patient. Hope you enjoy the video. Have a great day.